This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, today I'm really excited. We have a great guest with us today. This gentleman is, I think he's a legend in real estate investing. He's really gone to a lot of places other people haven't and approached things in even a different, unique way. I happen to be a frequenter of biggerpockets.com. I write a blog there, and I involved in forums and a lot of other areas, and his name is legendary there. But I'm talking about Jay Scott, and he goes by Jay. The letter J is a full-time entrepreneur and investor living in the suburbs of Washington, D.C. Jay is an engineer and business guy by education and spent much of his early career in Silicon Valley, California, where he held management positions at several Fortune 500 companies, including Microsoft and eBay. In 2008, Jay and his wife, Carol, decided to leave their 80-hour work weeks and the constant business travel behind. They quit their corporate jobs, moved back east, got married, started a family, and decided to try something new. That something new ended up being real estate. In the past 9 years, they have bought, built, rehabbed, sold, lent on, and held over $40 million in properties. Jay runs the popular website 123flip.com and is the author of 3 books on real estate investing, including his best-selling book, The Book on Flipping Houses. His books have sold over 100,000 copies in the past 5 years and have helped investors from around the world get their start with real estate investing. Well, Jay, welcome to the Old Dogs REI Network.
Hey, Bill. Thanks for having me. It's great to be here.
Oh, it's great to have you on. I've been looking forward to this.
This is awesome. Thank you.
Jay, I thought maybe we'd start off. I gave an intro there, and I don't want you to have to repeat things, but I really love to hear how you got involved, how you went from this high-tech career into real estate investing.
Yeah, so it was 2007, I guess. My wife and I had been dating for about a year and a half, and we had met in the tech industry. We both worked for the same tech company, and she was traveling a good 3.5 weeks a month. I was traveling a couple weeks a month for my job, and we hardly ever saw each other. And as two 30-something single people, that wasn't really a big deal, but we knew that as soon as we had decided to get married and start a family, that we really needed to change that lifestyle. We couldn't keep doing the 80-hour, 100-hour work weeks when we had kids. And I guess we could have done it, but we didn't want to do it. So we sat down, and I thought it was going to be a difficult conversation, but it was actually a very easy conversation where we both agreed that we wanted to get out of the corporate world. We wanted to get a little bit closer to family on the East Coast, and we wanted to start doing our own thing where we could kind of have a lifestyle business that would allow us to work when we wanted to work and spend time with the family the rest of the time. We kind of both made a commitment early on that once we had kids, we didn't want to miss soccer games, we didn't want to miss piano recitals, we didn't want to miss any of the big milestones in our kids' career. So we knew we had to kind of branch out on our own and do our own thing. So we got to the East Coast back in mid-2008, probably the worst time in modern real estate history to be an investor. Foreclosures were at an all-time high, and we were in Atlanta, which had really gotten decimated by the mortgage crisis. But somehow we fell into flipping our first house. I think my wife was watching a show on HGTV and said, "Hey, we should try doing that." And so we didn't have much going on before our wedding in August of 2008. So in July of 2008, we started making offers on houses. And we bought our first house literally the day we got married. We were at the closing table at noon, and we were at our wedding wedding reception at 4:00.
No way.
Yeah.
That's crazy.
And for us, it wasn't this wasn't going to be a business. This was just something fun to do while we were trying to figure out what our business was going to be. And one thing led to another. About 2 weeks later, we bought our second house because we found two around the same time that we liked. About a month after that, we bought our third, and within that first year, we had bought 14 houses. It wasn't a planned thing. It happened organically, and before we knew it, we were in the business of flipping houses.
Unbelievable. Now, did you have any kind of experience like with construction or any of the other skills that you might have needed for that?
That's the funny thing. I had absolutely, and my wife as well, we had absolutely no real estate experience. We had purchased our first house together when we moved to Atlanta about 3 months earlier. So we had hardly ever owned a property, let alone an investment property. I could barely swing a hammer. My wife was scared to let me try and change a light bulb. I might be the only electrical engineer on the planet that can't change a light bulb. So we had essentially no real estate experience. What we did have was some good business experience. And my plan from the beginning was to kind of approach real estate from a business perspective, and focus on the pieces of the business that were less real estate intensive, less construction intensive, and kind of outsource that to the people that were the experts, the contractors, the real estate agents, the appraisers, the inspectors, et cetera. And for my wife and I to more focus on the business aspects, the financing aspects, the things that we were good at, the things that we felt like we had more control over.
Now, where were you getting your houses? At auctions or just on the MLS?
So again, we started in 2008, and back then there were more foreclosures than probably any time in history. And we were in Atlanta, where there were probably more foreclosures than any place in the country. So when we started investing, we could literally go on the MLS, throw a dart, and whatever it hit, that was probably going to be a pretty good deal. To date, I think, let's not say to date. During the first 3 years that we invested, I think we bought something like 50 or 60 houses. All but one of those was an REO that was purchased right off the MLS. They were all bank foreclosures.
Wow. Now, what was the usual hold on a house that you would buy?
So our typical turnaround, and again, I'm a big data guy, so I always look at my metrics and try and optimize for things. But again, things have changed over the years because we've started getting into a lot of different types of projects. But over our first 50 flips or so, our average hold time was right around 101 days, so just over 3 months.
Wow. That's pretty quick. That's great.
Yeah.
And did you refine that over time, or is that pretty much the average for the most part?
Well, it's funny. So the different laws that have come into effect and gone out of effect over the last 10 years have affected things a lot. I remember back in 2008 when we started, there was a rule for FHA buyers where they couldn't purchase a property that the seller hadn't owned for at least 90 days. It was often referred to as the 90-day rule. And so if we wanted to sell one of our flip properties to an FHA buyer, and a lot of our buyers back then were FHA buyers, even if we had purchased it and rehabbed it and put it back on the market in 2 weeks, we couldn't resell to an FHA buyer for 90 days. So a lot of times that 100-day average hold period was related to the fact that we had to wait until day 91 to close the property, to sell the property. And so in 2000, I think either 10 or 11, HUD changed that rule so that you no longer had to wait 90 days. And our average hold period after that rule was changed dropped considerably, because suddenly we could buy a property, we could renovate it, and we could sell it 3 or 4 weeks later. We didn't have to wait 3 months. But then in, I guess, 2016, maybe 2015, 2016, they reinstituted that rule. So once again, we have to wait 90 days. So a lot of our metrics are impacted by external variables that we don't control. And that's a good example of one of those things that you need to be aware of in this business, that there are a lot of rules and regulations that can change your business plan in ways that you don't want or don't expect.
Were you buying the houses at the same price point for the most part?
Yes, we had a very cookie cutter business for the first few years. Every house we bought, we were buying houses that in 2005 and 6 were selling for $150,000, $160,000, but we're selling at foreclosure prices of $30,000, $40,000, $50,000. So we were buying properties in the I'd say $30,000 to $60,000 range. We were putting in generally between $15,000 and $25,000. We were doing the same thing to every house. The construction costs only varied by the size of the house. And then we were reselling in the $100,000 to $110,000 range for a profit of anywhere from $15,000 to $20,000. So it was relatively low margin for us, but we were making up for it in volume. We were doing a good 15, 20, 25 deals a year.
Wow. So you must have had multiple crews going on, I would imagine, in various parts of the city.
We did. Most of it wasn't various parts of the city. Most of our deals were all within about 5 square miles. We had picked an area of the Atlanta suburbs. The city was called Austell, Georgia. It was Cobb County, Georgia. And we were finding enough deals in that one area to essentially keep us busy. And so we decided, hey, as long as we're really good in this area, we know the inspectors, we know what houses are going to appraise for. In fact, houses were appraising based on the comps that we were setting. We were pretty much the only people in that area that were selling houses during that time. So we always knew what our houses were worth, because the comps that the appraisers were using were other houses that we had sold. And so we liked that control we had. We liked the fact that we were doing the same types of houses in the same location. Our crews didn't have to travel long distances. We knew what things were worth. We knew the agents that were working in the area. So we did our best to basically just stay in one really small area for as long as we could. Come 2011, 12, 13, there was a lot more competition. We couldn't find as many deals in that small area, so we had to branch out. But for the first few years, we were literally within about a 5 square mile radius of our first house.
So it was with the first flip that you really realized, hey, this is something we can do. I mean, this is something we like, something we enjoy.
It took a little while, the first flip, and I'm sure at some point we'll probably talk about the mistakes we've made. But our first flip, we made a lot of mistakes. It was very frustrating. I often say that if we didn't buy 2 other houses while we were renovating the first one, we probably never would have bought a second house. The first house was a lot of work. It was like I said, it was very frustrating. It wasn't until we had done 2 or 3 or 4 deals that we realized, hey, this is something that we could turn into a business. This is something we could scale. So we're fortunate that we didn't just stick with one house at a time, that we actually bought a couple and could see the good side of investing, along with the bad side that we saw in that first deal.
How did you do with the contractors? I mean, did you have to go through a lot of folks before you really found ones that you could, count on?
No, that was one of the nice things about starting back in 2008, because the market had gotten decimated. Most contractors had gone out of business. The only contractors that were left were the good ones, the ones that knew how to manage their cash flow, the ones that were good at marketing, the ones that had good customer service. The average contractor had gone out of business, and so we had our choice of essentially good contractors or great contractors. And because there was so little business from homeowners and investors during the 2008 mortgage crisis, those contractors were willing to work at very reasonable rates. So what we found was that the contracting part of the business, while today is probably the most difficult part of the business, back then it was actually the easiest. We could walk into Home Depot at 7 a.m. and any contractors that were there shopping for materials were probably pretty good contractors because they still had work. They were getting up at 7 a.m. and they were going to Home Depot. And literally, we would just go to Home Depot early in the morning, collect cards, and most of those contractors ended up doing work for us. We had contractors who literally spent 7, 8 years with us before they quote unquote expired. I like to say that most contractors have an expiration date. Either you get sick of them or they get sick of you. And these days, that expiration date's typically pretty short. But we had contractors who were with us from like 2008 to 2015 or 2016. It was great.
Wow. Now, you were in Atlanta when you were doing all this, right?
Correct.
So you're up in the D.C. area now. What sort of prompted that move?
So we had 2 kids in 2009 and 2011, and Atlanta was a great place to flip houses, but it wasn't a great place in terms of schools to raise our kids. So again, family first for us always. So when the kids were close to school age, we decided we wanted to move someplace that had considerably better schools. And I grew up in Maryland, and my wife is from upstate New York, so Maryland was a little bit closer for her. But we found a county in Maryland that had fantastic schools where some of our friends had settled down. So it was very much a lifestyle decision to move to Maryland, not so much a real estate or business decision.
That kind of prompts that next question is, when you got up there, I mean, were you going to continue to flip? Were you moving in different areas? Were you in different parts of the country? What sort of happened with your business?
So yeah, we were fortunate that before we moved up to Maryland, we had started doing some investing in other cities. We had moved into Milwaukee, where at that point we had done 30 or 40 deals. And so we were prepared when we moved to Maryland, we were prepared to either start investing in Maryland or continue investing in Atlanta or find other markets. We had really gotten to our business at that point to the place where we were comfortable doing deals outside of our local geographical area. So we came to Maryland with the attitude that we would hopefully do a bunch of deals in Maryland, but if for some reason we found that the market was too tough or we couldn't find enough deals, we could continue doing things in Atlanta, we could continue doing things in other cities around the country. Turns out that Maryland is a very, very tough place to be doing deals. There are a lot of deals, but there's also a lot of investors between Baltimore and Washington, D.C. and Northern Virginia. It's just very, very populated, high population densities, lots of different urban and suburban areas. So there's just a lot of investors competing for a lot of deals. So we certainly have done a decent number of deals since we've moved to Maryland, but to keep that pipeline filled, we're also doing a number of deals in Atlanta. We're doing some stuff in upstate New York. And we've started to transition our business a little bit more to buy and hold, to multifamily investing, and so that's allowed us to expand our geographical range even more.
Yeah, I was going to say, doing flipping, from a distance. I mean, people do it, but it's got to be a challenge.
It's definitely tough. I tell people that want to start their business by flipping long distance that we had done about 100 deals before we ever took on our first long distance project, and some of the most difficult projects we've ever done were long distance, even with that level of experience. So I generally caution people, if you're going to flip long distance, first get some experience before you do so, and second, just be aware of the fact that it's frustrating, it's time consuming, and there are a lot more risks than there are with local investments.
What percentage of your activities right now are flipping still? You mentioned you're moving into multifamily. Are you still doing a lot of flips?
Yeah, so over the last few years, we've been doing between 20 and 30 a year. This year, we're probably down to about 15. If we can stay between 10 and 15, I'd be happy with that. And we're also, this year, we're going to have picked up about 50 units as rentals, so 38 unit multifamily and some single family and some duplexes. And we're also doing some new construction. So in those 15 flips that I mentioned this year, about half of those are actually new construction projects. So I use the term flip, but some of those are new construction. And we're doing some lending and we're doing some note deals. So we're kind of branching out into a few different areas. One of our philosophies is that we don't necessarily do what we enjoy doing. We tend to do what the market best allows us to do. And while we very much enjoy flipping and building, the market's gotten to a place where we feel like we need to branch out a little bit more to continue to keep the deal pipeline filled and to continue to generate the income that we've been generating the last few years. So we're very market driven. So if the market allows us to continue doing flips, we'll do it. If the market dictates that we have to change our strategy, we'll do that as well.
Yeah, new construction's definitely a different baby than flipping. And that's one of those, you just have to pour tons of capital in up front and wait, right?
It's definitely true. New construction it's more capital intensive. The cycles are a little bit longer depending on where you're doing it. For example, City of Atlanta, you can wait 12 months to get permits. So it can be a 2-year process to build a property. But on the bright side, there's also some benefits. So with new construction, there are rarely any surprises. So we are typically within 1 or 2% of our budget on our new construction projects, whereas on a flip, we can be off by 5 or 6 or 7% on a construction budget. So one of the nice things about new construction is that it's a lot easier to forecast your profits, but certainly there are longer construction cycles and project cycles, and so you're more at risk of things changing in the market. So there are trade-offs. There's good and there's bad.
Are you doing large developments, or are you dealing sort of one lot at a time? What kind of new construction are you doing?
We would love to get into doing subdivisions and developments, but again, that in terms of things being market driven, we find it very hard to compete with the larger builders that are picking up lots that they can subdivide into 10 or 15 or 20 different lots. So we have completely stuck with what's called infill developments, basically buying an existing property, knocking it down, and building a new house. So it's all spec building of one single family house at a time.
Gotcha. Now, I know back in the day that, some folks would do that and they'd leave one wall standing and be able to consider it a rehab. I mean, do you do that, or is that any advantage to that?
No. So most, I shouldn't say all, but most jurisdictions, most inspectors are wise to that little trick, and they've tightened up their regulations. And we don't like to cut corners. So if we're going to knock a house down, we're going to take the foundation with it. We're going to pour a new foundation. It's a little bit more money, but we want our buyers to know that they are getting a new house and they're not going to have to deal with defects in old construction. They're not going to have to deal with old foundations. And so I do know investors that are cutting corners like that and just trying to get around the regulations, to get around the extra time it takes to get new construction permits. But for us, I like to sleep well at night, and I sleep best at night knowing that we're doing everything right and we're not going to ever have to worry about an inspector calling us on something or giving us a stop work order, or have a buyer call us and say, hey, you didn't replace the foundation and now we have leaky basement walls. I don't want to have to lose sleep at night over worrying about those things. So we typically do things the right way, even if it costs a little bit more money or takes a little bit more time.
Yeah, I can definitely understand that. That's smart. Now, you're moving into multifamily. Maybe you could talk a little bit about that.
Sure. I had a goal a couple years ago of buying an apartment complex, and this was actually the original plan my wife and I had when we jumped into this business. We had talked about buying apartment buildings and doing buy and hold, but back in 2008 in Atlanta, the market just wouldn't allow us to do that. There was very little transaction volume. Few sellers were selling apartment buildings. The ones that were wanted way too much money. So we didn't get into that originally. And then back in, I guess, 2015, this idea of buying apartments was kind of resurrected in my head. I don't know. One day I woke up and said, hey, I don't know why we never did that. But unfortunately, our timing was off again. So between 2008 and 2015, there was a couple good years for buying apartments. We were so focused on flipping that we didn't think about it during that time. So by 2015, when I was ready to do it again, once again, it wasn't a great time. It was hard to compete with some of the bigger investors who were buying the 100, 200, 300 unit complexes. It was just hard to find deals. So between 2015 and this year, we've been looking for multifamily deals, but we've been looking in the 100 to 200 unit range. A few months ago, a partner of mine said to me, maybe we should be looking in the 20 to 50 or 20 to 80 unit range instead of the 100 to 200 unit range. I think there's a lot more opportunity there. And what we found is he was completely right. When we started looking in the closer to 50 unit range as opposed to the 100 unit range, what we found was there were a lot more deals available. So this year we purchased our first 38 unit a couple months ago, and we have a 16 unit under contract now. And so we kind of found a sweet spot in the market that's working for us. And so once again, we're letting the market dictate our strategy, and I should have been more flexible about that a couple years ago. We probably would have bought some deals sooner, but we've kind of figured out a good niche for right now.
Oh, that's neat. I am going to ask you what you would consider one of your biggest mistakes and something that you learned from in that process, whether flipping or buying, buy and hold, that area where you really learned.
Sure. First, one of the things I like to tell people is if you make the best decisions at the time, if you're always doing your best to make good decisions, there's no such thing as a mistake. So oftentimes things don't work out. Oftentimes you can look back with 2020 hindsight and say, I should have done something different. But if you can make the best decisions at the time you're making the decision, it's not worth kicking yourself and calling it a mistake, because all you can do is make the best decisions. And if you repeatedly make good decisions, things will magically work out for you. So I don't like to think of too many of the things that we've done as mistakes, except where we've made decisions that we knew at the time were not the best decisions. But if I had to point out one deal that I think we made the most mistakes on, it would certainly be the first one. Our very first flip, we overpaid. We knew at the time we were probably overpaying, but we were so gung-ho about getting a deal under contract and just getting started in the business that we didn't notice that, I guess in retrospect, we probably overpaid by about $10,000. That same deal, we underestimated our renovation costs by, I think, $15,000, if I recall. And again, that was a mistake that didn't need to be made. We were so excited that we didn't do the due diligence we should have done. We did a quick back of the napkin estimate for the rehab costs, and we didn't know how to estimate rehab costs at the time. So not only was it back of the napkin, but it was back of the napkin with probably very bad numbers. And it turns out we were about $15,000 under the actual rehab cost for that project. And then on the back end, we thought we could sell it for, I think our price was $115,000. And what we found was we couldn't sell it for that price. We overestimated the resale value. So instead of selling it, what we did was we decided to hold it as a rental, and we held it for about 2.5 years. We tried lease optioning it. We tried lease purchasing it. None of our buyers could ever qualify for financing to refinance. And then after 2.5 years, we had to do a second renovation on the property, and we eventually sold it. This was the first property we bought in August 2008. We eventually sold it, I think, in 2011. And we were, again, very fortunate that we were conservative in our original numbers. We built in a lot of profit. So even with the overpaying by $10,000, spending about $15,000 too much in renovations, holding the property for about 2 years longer than we expected, we still eked out about $1,000 profit on that property. Part of that was the market helped us. There was some appreciation in the market between 2008 and 2011. But we made pretty much every mistake you can make on a flip project on that very first deal. And I look back and I don't like to refer to them as mistakes because we learned so much on that first deal that we can pretty much attribute all of our future success, all of our success since then, to the issues we had on that first deal. So it was actually a good thing in retrospect.
Yeah, I'm with you on that. I believed true. I think the real education starts with the first purchase, and that's you can read all the books you want, you can go to the seminars and the webinars or whatever, but really the education starts after that first project. And so
exactly,
I don't look forward to those things to happen, but when they do, I'm thankful they do because I usually learn so much in the process that I'm just that much higher, ahead in the next deal. So it definitely makes sense.
yep.
Well, conversely, what would you say your biggest success was?
We've been so fortunate with a lot of things in this business. So a lot of people like to say that a lot of people like to attribute all their decisions to their success, and I think we've made some good decisions over the years. But a lot of our success is it can be contributed to the fact that we had some good timing. We got into the business at the right time. I'd say a lot of our success we can contribute to the fact that we've worked really hard to build relationships, good relationships over the past couple years. We have a good reputation in the business. We have a good brand, and that's helped us tremendously. The people we've met have helped us to be successful. We try and help other people to be successful. I think we can take some credit for our success. I think I think that's fair, but we owe a lot of our success to good timing, surrounding ourselves with good people, doing the right thing. Really, our success in this business is attributed to just every day, just waking up and just having the right attitude and doing the right thing, and then hoping and letting everything kind of fall into place. When you do the right thing and when you make good decisions, things just tend to fall into place. So I can't attribute it to anything specific. It's just every day just trying to do the right thing.
That's neat. That's really neat. And one thing that's got to be really great is just being able to work with your wife, Carol, in this process too, because you both have that same focus, same interest, and obviously different strengths that you can draw upon, which seems to make it work on your end.
So I tend to be the face of our business. People know my name, but the truth is Carol deserves 90% of the credit for our success. She is brilliant at marketing. She is brilliant when it comes to working with people. She's got an amazing personality. Everybody that meets her loves her. So she's built some tremendous relationships over the years. A lot of our deals have gotten sold simply because she can pick up the phone and call another agent or call a buyer and just start a conversation and build a relationship. We found a lot of our deals because we'll buy a house and she'll just knock on the neighbor's door and start talking to them and build relationships with our neighbors. And we ultimately end up buying their houses or their friends' houses. Her ability to build relationships and then kind of leverage those relationships, and it's all very natural. It's not like she goes in with the intent to build relationships for the benefit of the business. She just likes people, and that has helped our business probably more than anything else we've done. So working with my wife has been great in so many respects, but probably the biggest is just that she's the one that's made this business successful for us.
Oh, that's neat. That's really neat. Well, one area I wanted to touch on here, because to me, it's a great book that you've put together. It's called An Introduction to Real Estate Investment Deal Analysis. Now, this is one of the areas we have all kinds of folks that listen to this. Some of them, maybe flipping. Some of them are investing in single-family homes. Some are buying apartments, multifamily, and there's this area of deal analysis. I just find there's just a real vacuum for yeah, they want information. People get these analyzers, these Excel spreadsheets, they get software. There's all these different ways to analyze a deal, and I hear it time and again, it's just overwhelming. It's hard to be able to really know if it's a good deal or not because there's so many variables. Maybe you could just kind of give us a good sort of overview or look at how you analyze your deals, because it looks like you definitely got it down, and you're making money on your deals. You're picking the right deals. How do you generally approach a property you're going to buy, and let's say maybe we can use like a buy and hold type of situation, and in terms of some of the key issues that you look at for analyzing a property.
Absolutely. So let me start by saying that I 100% agree with you. There's so many tools out there. People tend to get very overwhelmed when they are analyzing deals, especially buy and hold deals. It's a little bit more simple with flips, but for buy and hold deals, people tend to get very overwhelmed. And what I tend to find is that the reason people get overwhelmed is because they don't decide up front what their goals are for a property. A lot of times they go in and they say, okay, let me see if this is a good deal or a bad deal. And there are so many different metrics that you can measure for a buy and hold deal. For a flip deal, you basically had, this is my profit. Is it enough profit to make the deal worth it based on the amount of time and effort I put in? But for a buy and hold deal, there are so many different metrics that you can look at. There's the cash flow that the property generates, so how much income the property generates for you at the end of every year. There's how much it's going to cost you to purchase a property. So if you buy $1 million property with cash, you're at $1 million. If you get a 90% loan-to-value loan on that property, you're only at $100,000. So that's one thing to consider. Some people buy properties for tax benefits. So if you have a separate business and you're generating a lot of W-2 income and you want to offset some of that income, you can do that with real estate. So some people don't care about the cash flow. They don't care how much they're paying, but they want tax benefits. Other people are looking to build a retirement. So they don't necessarily need cash flow today, but they want to know that every month their tenants are paying down their loans, and in 15 or 20 or 25 years, they're going to have 1 or 2 or 50 or 100 paid off properties that are going to finance or support their retirement. So everybody has a different set of goals for buy and hold real estate. And without knowing what your goals are up front, all the data that's generated can be overwhelming. But if you know what your goal is going in, if you know that my goal is to supplement my income and I want to invest $500,000 and I want to make 10% return on that $500,000. So I want to generate an extra $50,000 per year in income. Now you have a goal that you can pretty easily measure for a property, and you can say, can I put $500,000 into this property, get a 10% return, so I'm getting 10% or getting $50,000 every year. Or if your goal is, I want to build $100,000 in cash flow in 30 years. I want to be able to buy properties now, get loans on them, and know in 30 years that I'm going to have 100 paid off properties. Or if you go in with the attitude, I need $20,000 in tax write-offs at the end of this year, I'm going to buy this property if it generates $20,000 in tax write-offs. Knowing what your specific goal is allows you to analyze the property in a way that you can determine if it meets your goals. If your goal is tax benefits, you can ignore a whole bunch of metrics. If your goal is long-term wealth, you can ignore a whole bunch of metrics. If your goal is cash flow this year, you can ignore a whole bunch of other metrics. And you can focus on those metrics that allow you to determine if the property meets your particular goal. So all that's a long way of saying before analyzing a property, figure out why you're buying that property. Figure out what your goal for that property is. Is it cash flow? Is it tax benefits? Is it long-term wealth? Whatever it is, figure that out, and then analyze the property based on that particular perspective? Does the property meet your particular goals? Because a property could be great for you and horrible for somebody else, or it could be great for somebody else and horrible for you, because the two of you have different goals. So that's the biggest thing I see that's the biggest recommendation I would make to anybody before they start analyzing a deal, is to figure out what the goal for that particular property is, and then move forward after you've figured out what the goal is.
God, that's great. Very, very wise statement. I couldn't agree with you more. I think that's key. There, in analyzing deals too, though, you have the criteria, which is different than the goals, right?
Yep.
And I'm trying to sync those two together is where it sometimes gets a little difficult. For example, I don't want to buy property older than 1980s, built in the 1980s. I'm looking for a cash on cash return of 10% plus. I'm looking, putting all this various criteria together. I guess you have to know the goals too at the same time, but some of them don't really relate to the goals. Like, buying a newer property,
sure.
Just from the general understanding, you don't want something that's going to have a lot of capex,
sure.
happening right away. So I don't know, maybe you can kind of address that area a little bit.
Absolutely. So a little nugget that I think will help people, because a lot of people don't realize this, but typically the amount of return you get on any investment. So when I talk about the amount of return, whether you're getting a 5% return or a 10% return or a 20% return, typically the amount of return you're getting on an investment is directly proportional to the amount of risk in that investment. If you buy an apartment building that's generating 15% returns, and I buy an apartment building that's generating 5% returns, the one key thing we can say about the difference between your investment and my investment is that my investment is going to be a lot riskier than yours. And what that risk generally translates to in the real world is your building might be older. Your building might be in a rougher part of town that's attracting more difficult tenants, higher tenant turnover. Your building might require a lot of renovation up front. Your building might be in a part of town that is losing jobs. All of these things are going to contribute to risk. And it's because you have higher risk that you're going to be getting a higher return on your money. So I would say to anybody that's looking at setting their criteria, they should be aware of the fact that if your criteria for return is high, you better have a higher risk tolerance, because that's essentially what you're getting that higher return for. You're getting the higher return to compensate you for the higher risk. So if you want very, very low risk and very, very high returns, well, you should consider that you're probably not going to find that. I'm not saying those deals aren't out there. Maybe you're a fantastic negotiator. Maybe you get lucky and find that deal of the century. But typically speaking, low risk and high returns don't go together. It's just a good way to frame the way you think about what you're looking for. And you should decide up front, am I willing to accept higher risk in order to generate higher returns, or do I really, really care about that low risk scenario and I'm willing to accept lower returns for that lower risk? So that's when it comes to setting criteria, that's the trade-off that I think a lot of people don't think about, but it's another thing that's really, really important to think about. Second, I think a lot of people, when they look at a deal, they leave out a lot of factors. So you can look at the financial metrics for a property all day, and the financial metrics can look great, but there are so many other things that are part of buying a property. So again, there's the headaches. So we talked about maybe your property's in a worse part of town and you have a worse set of potential tenants and there's higher turnover. But then there are the headaches that people don't even think about. So I mentioned earlier that we found some opportunity in the 20 to 50 unit space because we couldn't find opportunity in the 100 plus unit deals. And what we found is the 100 plus unit deals are generating returns these days in the 5, 6, 7, 8% range. We're getting returns for our 20 to 50 unit deals in the 11, 12, 13, 14% range. So some people might say, okay, obviously we should go for the 20 to 50 unit deals because that's a much higher return than the 100 to 200 unit deals. But what they don't realize is that's because they're hidden costs, not financial costs, but hidden headaches when it comes to 20 to 50 unit properties. The reason why these properties are available is the folks that are buying the 100, 200, 300 unit deals, they don't want to touch the 20 to 50 unit deals because 20 to 50 units is really tough to manage. You don't get enough income from the property to hire full-time on-site managers, but you're having enough turnover and headaches that you have to have somebody at the property pretty much full-time. So the management of the 20 to 50 unit deals is a lot tougher. You typically have one or two tenants that are dealing with maintenance issues, or you have a tenant that's willing to sit in the front office and take applications from prospective tenants, or you hire a property management company that is willing to be on site 2 or 3 hours a day as opposed to full time. But these types of management scenarios are much tougher to manage than the larger apartment buildings where you just hire a full-time management company. They sit in the front office for 8 hours a day. And so again, you're being compensated for the risk. And so a lot of people look at these deals and they say, okay, I want to do a 30 unit because it's generating 15% returns versus that 100 unit that's generating 8% returns. But they don't realize that the hidden cost, the hidden risk is that management becomes a lot more difficult. So I often tell people, when you buy a deal, look at the financial metrics, but also think about things like management. Think about things like who your tenants are going to be and what type of tenant turnover you're going to have. Think in terms of what your CapEx is going to be. If you buy a property that's on septic versus sewer, every 20 or 30 years, you could have a good $200,000 expense having to rework your septic field. These are all the things that they're not purely financially driven, but are risks to the project and other things that need to be taken into account. Does that make sense?
Oh, great points. Great points. Just out of curiosity, for your apartments, the 13, the 16, what is your criteria going in? What are you looking to get?
Sure. So typically for our single family houses, when we buy our single family rentals, we want about 12% returns. So we want to know that if we have $50,000 invested in a property, we're earning $6,000 per year in cash flow on that. In addition, hopefully we're getting some tax benefits. Hopefully we're getting some equity from paying down the mortgage every month. Hopefully we have some equity in the property because we bought it for less than it was worth. And so those things are important, but typically the 12%, what we call cash on cash return. So if I took that $50,000 and put it in a bank account, I might be getting 0.5% interest. If I put it in a 5-year CD, I might be getting 1.5% interest. I want to know I can put it into a piece of real estate and get $6,000 in cash flow or interest every year. For our larger properties, so like the 38 unit that we bought, this was a low income area of town. This is a lower income property, so the headaches are going to be a good bit higher. So we went in with the attitude that we only want to purchase this property if we can get 15% returns. So we made an offer to the seller based on the number that would allow us to get 15% returns. And we also had a goal of having at least $100,000 in equity. So we bought the property for $600,000. Our goal was that the day we bought it, or not the day we bought it, but after we bought it, we could fix it up. And the day that it was all renovated and ready to go, we had built in about $100,000 in equity. So we went in essentially with these two goals, 15% cash on cash return and $100,000 in equity. And then we worked the numbers backwards to figure out how much we could pay for the property to generate those two key returns for us. Those were our goals. And again, other people might have gone in with the goal of generating a 20% return and no equity. Somebody might have gone in with the goal of having a $20,000 a year tax write-off. Everybody's goals are different, but ours were 15% cash on cash return and $100,000 in equity, and we made our offer based on those two goals.
Now, are you self-financing these, or do you have investors?
I have partners for a lot of the deals that we do.
Mhm.
And so I'm a big fan of owning things free and clear, but I'm also a big fan of using leverage wisely. So what we will typically do is we will buy deals that we know we could pay cash for, if we had to, or if we get into a situation where we decide we don't want to have a loan on the property, but then we will refinance and we'll pull some of that cash out. So we like to be, I guess you could call it, we're very conservative in our financing, but we've used banks for financing. We've used small local banks, what are called portfolio lenders, for financing. I'm a big fan of partners. I've used private money. I've done some hard money years ago when we had more deals than we had cash. So I've kind of run the gamut on financing, but these days it's a lot of it is partners, and very conservative bank financing.
Do you see yourself, if you do move into those 100, 200 units, going syndicating at some point?
Yeah, so certainly that's going to be out of our range of being able to finance it ourselves, or even with one or two partners. So the thought has always been, if we can come across one of those deals, we would syndicate it, and we know a good number of investors who would love to get into those types of deals. So hopefully, if and when that day comes, we will be able to raise the money.
That's great. So for analyzing something a little bit more complicated like multifamily, do you have your own little spreadsheet you use, or do you use stuff that's already out there?
So it's funny, and let me throw out, if anybody wants to go on my website, 123flip.com, you can sign up for my newsletter. I don't sell anything, so if you sign up for the newsletter, you'll basically get a link to a whole bunch of documents and tools and forms and stuff that I make available. And one of them is a buy and hold spreadsheet, and it's relatively simple. I actually use the same spreadsheet to analyze my single family deals as I use to analyze my 200 unit deals, or the 200 unit deals that I'm looking at, not that I've ever purchased one. And so what I found is that, yeah, you can do ridiculous amounts of spreadsheet work and measurements, but typically it doesn't require that much more work to analyze a big deal than it does a little deal. The metrics are pretty much the same. The harder part of a big deal is collecting the data. So the analysis looks pretty much the same. It's just a lot harder to figure out what the actual data is. So figuring out the vacancy for a 100-unit complex is a little bit more difficult than figuring out the vacancy for a single-family house. Figuring out the CapEx for a 100-unit deal is going to be harder than figuring out CapEx, prorated CapEx costs for a single family. So those sorts of things, figuring out what your average utilities bill is going to be when you're paying water for 100 people versus when your single family tenant's paying their own water bill. So gathering the data tends to be a lot tougher for the bigger properties, but analyzing the data, the methodology is the same, and I actually use the exact same spreadsheet no matter how big the deal is.
That's great. I love it. Well, our audience here are folks that are 50 plus. They may be mid 50s that are approaching retirement. And then there are those that are already retired, and they've been retired for a number of years. This group is looking at real estate investing as a means to be able to either supplement their income today, or in the short term. And in looking at that, kind of add some years onto your life here, and you're in this situation. Many of them have, come out of places where they didn't really have a pension, or maybe they had a small pension, or they've tucked some money away, maybe sold a house, and they've got $1 million sitting in the bank somewhere or something. But the idea is they're looking at a way to be able to cover the costs of their retirement, also to create a legacy that at one point they might be able to hand down to their kids, something that will have sustained value over time. How would you advise those folks that are listening here that are really trying to look at some way to utilize real estate investing to help fill that gap? And what would you recommend?
Sure. Well, I'm going to go back to something I said earlier because I think it applies to a lot of situations, but this one as well. When I talked about setting goals and knowing what you're trying to achieve, and I talk to a lot of people who talk about real estate, and these are people of all ages. I'm 46, so I'm probably not in your 50 plus crowd, but I'm not too far away. I talk to a lot of people who say, yeah, I'm getting into real estate for the money, or I'm getting into real estate to build a retirement or whatever. And when I say to them, so what does that mean? How much money do you need for retirement? How much cash are you trying to generate every year? They're like, well, I don't know. I want to use real estate to do it though. And what I say is start with your end goal in mind and work backwards to figure out what you need to do to achieve it. So if your goal is to achieve, let's say, $5,000 a month in income. So let's say you're trying to replace your current salary at $5,000 a month, and if you can do that, you can basically retire. So you know that to replace $5,000 of income a month, that's $60,000 a year, and so there's a lot of ways to replace $60,000 a year, but let's say you decide you want to do buy and hold real estate. So let's say you've decided you're going to do buy and hold real estate, and you want your buy and hold real estate to generate $60,000 a year in cash flow for you. Okay, you can work backwards and you can say, how much do I think in my area, based on the types of deals I'm going to find, what's the return going to be? And so you might say, I've talked to other investors in my area. They're buying rental properties, and what they found is they are generating about 10% returns every year. Great. So now you know that you want $60,000 a year in cash flow, and you're going to do it with properties that are generating 10% returns. You can divide $60,000 by 10%, and suddenly you've realized you need $600,000 to invest. You need to put $600,000 into a property or properties, and those properties, if they throw off 10% returns per year, are going to generate your $60,000 in income. So now you have a goal. You have this goal of, I need to generate $600,000. Maybe you have $600,000 in your bank account. Maybe you have $600,000 in your retirement account. Maybe you have nothing and you need to start from scratch to build that $600,000, but you've now set that goal in your mind. You know how much money you need to achieve your goal of generating $5,000 per month in income. And then you can work backwards from there. So let's say you have $300,000 and you know you need $600,000. So, and you want to retire in 5 years. So you know that over the next 5 years, you need to grow that $300,000 to $600,000. So that's $300,000 over 5 years, or about $60,000 a year in extra cash that you need to earn that you can put away to invest. So how do we earn $60,000 per year? I don't know. Maybe you can flip a house. Maybe a typical house flip in your area generates $20,000 in profit. So now you know you need to do 3 house flips a year for the next 5 years, which will give you $300,000 in profit. Added to the $300,000 that you have will give you the $600,000 that you can now put into investment real estate, rental real estate, that's generating 10% per year, and you can retire. And so again, working backwards, you're creating a plan. So now your plan might be 3 flips a year for 5 years, then I can retire. And people don't do this. Instead, they say, I want to buy real estate and I want to retire off my real estate, and they start buying stuff, but they don't know why they're buying it or how much to buy or what types to buy because they don't know where they want to be. So what I challenge people to do is, if you really want to use real estate as your means to retirement, figure out what retirement means to you and then work backwards to determine how you're going to use real estate and how mumuch money you need to achieve that particular goal.
Great answer. Wow. It's so great. You're very clear and very, I don't know, I just find that it's like your books. It's the same thing. You know, you just right to the point. There's not a lot of fluff. There's, you know, just boom, right to the, and I love it. I love it. That's the kind of stuff. And that's the only problem though, as an interviewer here, is usually I'm thinking of the next question. I'm listening so hard to you that all of a sudden you stop talking and I go, oh no, I've got to ask him.
This is what happens when you interview engineers.
No, I love it. It's great. You know, and it's funny. This is one profession that I find a lot of engineers going into, which is really makes sense.
Yes.
And they're very successful. So it's that's an interesting point. Good point. Well, Jay, what's ahead for you? Okay, you're living in Maryland, you're on the East Coast. You got kids, you're growing up, I know. And but what's sort of the future for your business? Where do you see it going in the next 10, 20 years down the road?
Hopefully we are not still working 20 years down the road. Like I said, I'm 46, so I hopefully well. That's not true. I'd love to be working when I'm 66. Hopefully, we're not still flipping houses. Flipping houses can be a very tiresome job. It's not something I want to be doing for another 20 years. But it goes back to what I said before. We tend to be very market driven. So what we're going to be doing in 20 years, I don't know. I can't even tell you what we're going to be doing next year. I'm actually very excited to try new things. We're like we mentioned, the syndication, something that we would love to do. But we try and keep our options open, and we see what the market hands us. We see where things go, and if an opportunity presents itself, we jump in. And I'd say that's one of my biggest pieces of advice that I'd give to any real estate investor is it's always great to know what you want to do and what your plan is, but don't ever be so tied to that when another opportunity presents itself, or conversely, when what you want to do doesn't present itself as an opportunity, that you're not willing to step back and say, okay, I'm going to do something else. Because I find too many investors, I'll use the cliche, one-trick ponies. They can do one thing really well, but when that one thing stops working, they kind of get caught with their pants down, and so I recommend to people get familiar with the industry, understand how things work at a fundamental level, understand how financing works, understand how buying and selling real estate works, understand negotiation, understand all of these things to the point that if tomorrow you have to go from flipping houses to lease options or buying mobile home parks or buying strip malls or wholesaling apartment buildings, whatever it is, if you understand the fundamentals in the business and you understand the financials and the way money flows, you should be able to more easily make that transition from one real estate niche to another real estate niche.
Great. That's another good answer there. Thank you. Well, we are, I could probably hold you on the phone here much longer, but I think there's a certain point where, you probably have to do something here. But we do have, this is what we call our wrap it up section. And this is where I ask you a series of quick questions. You give us, some good resources, things that you have found valuable that our listeners might also do the same. So if you're ready, I'll go ahead and we'll do our wrap it up.
Let's do it.
All right. Favorite real estate book?
There are a lot of good books out there, but I'm gonna go with so Brandon Turner from Bigger Pockets, who's a friend of mine. I'm not recommending this book because he's a friend of mine. I'm recommending this book because it's helped me tremendously. He has a book called The Book on, I don't have it in front of me, but it's like the book on buying rental real estate. And he has a companion book that his wife wrote that's called The Book on Managing Rental Real Estate or something like that. Two absolutely fantastic books for anybody that's looking to get into residential buy and hold, residential rentals. I highly recommend Brandon and his wife Heather's books.
I second that. Great book. Great books. Favorite business book?
So my favorite business book is one that a lot of people have never heard of, but it's called The Goal. It's written by a guy named Eliyahu Goldratt. I believe that's his name. And it is a book that was written I think it was in the 80s, and it's subtitled The Theory of Constraints. And it's all about basically processes, and it's written kind of in story form, but it's all about how businesses can deal with bottlenecks to make their businesses more efficient. And so for anybody that's running a business that wakes up every day and thinks, things just aren't running as efficiently as they could, I'm spending too much time doing X or Y, this is a great book to get you to think about how to organize and optimize your business and getting it to run as efficiently as possible. So a lot of people have not heard of this book, but it is my favorite by far business book. And again, it's called The Goal.
That's great. Great. How about most valuable website for success other than your own?
I have to throw out Bigger Pockets here. So people know me from Bigger Pockets, but it's not like I became a great investor and then partnered with Bigger Pockets and said, let's do stuff together. I started my career on Bigger Pockets. I was on Bigger Pockets back in 2008, about 6 months before I ever did my first deal. And a lot of what I learned about investing, what kept me from making too many mistakes early on, was what I learned on Bigger Pockets. So the site has certainly changed over the years. I've been involved in many different ways, but mostly I'm just a contributor. I think I have more posts on there than anybody. I don't get paid from Bigger Pockets or anything like that. So, but I do recommend anybody that's getting started in this business jump on Bigger Pockets, because there's just so much valuable information there, and then there are a lot of really smart people to answer questions. So that's by far my best recommendation for website.
I ditto that one, definitely. Favorite app?
So I use Excel for everything. I'm an Excel junkie. So if we can talk about I guess I don't know if that's an app or not, but I'll throw out two. So if Excel's not an acceptable answer, I don't use a whole lot of apps. I really don't. But one of my favorite is an app called Mile IQ, which allows me to track my mileage. So to anybody that's doing real estate, make sure you're tracking your mileage every time you drive to Home Depot, or you drive to one of your properties, or you drive to your closing agent's business or whatever. Track your mileage. Mile IQ is a really cool app that's on your phone that basically records every drive that you do. It knows when you've stopped. It has a GPS built in, so it knows when you're moving and how far you've gone, and it will actually show a little map of every drive that you've done. And then you can look at each drive individually and swipe left or right. And if you swipe right, you're saying that's a business drive. If you swipe left, that's a personal drive. And it'll basically categorize every time you drive somewhere, whether it's a business expense or a personal expense, and then you can just export that to a spreadsheet and send it to your accountant at the end of the year, and basically get deductions for all the miles that you drove.
Oh, that's a great one. They do have an Excel app, and I have it on my phone, but it's really hard to operate. No, I mean, it's not like having a mouse where you can click over and you can do this. You've got to find the little numbers and plug them in. I mean, it's a little hard. So, but those are two good suggestions there. All right, how about favorite quote?
My favorite quote, I think anything by Warren Buffett I probably like, but I think I'm paraphrasing here because I don't have it in front of me, but Warren Buffett, I think it was, who said something like, you don't need to do extraordinary things to get extraordinary results. And the reason I love that quote is too many people focus on being perfect and getting so good at one thing that they're the best in the world at something. And what people don't realize is if you just do things consistently, day in and day out, you do the right thing every day, you do good work every day, you're going to wake up one day 5 or 10 or 30 years from now and realize everything just magically happened to work out. And so you don't need to be the best in the world at anything. You don't need to be perfect at anything. Just get up every day and work hard and do the best you can, and you'll find that the results take care of themselves.
Well, our final wrap it up question. If let's say something catastrophic happened, you lost everything you have, every asset, all you have are $1,000 in cash, how would you rebuild your real estate investing business?
That's an interesting question. I would take that $1,000 and I would spend it on other people that I felt like could help me in this business. This business is about relationships, and when you do nice things for other people, it always comes back, or not always, but it normally comes back and it will help you as well. So I would take that $1,000 and I would buy my real estate agent a gift certificate for a nice dinner. Or the next time I walked into a potential seller's house to negotiate a deal, I would bring donuts. Or I would find another investor and take him to lunch or her to lunch. basically I would spend that money on building relationships and helping other people, and knowing that it would probably come back to help me many times over in the long run.
Right on. That's great. That's great. Well, I'm sure there's a lot of folks listening here that want to find out more about you and what you do. And what's the best way for folks to find out? I know you mentioned your website. To definitely
Yep.
give us that. But and even bigger pockets. But what's the best way that folks can reach you?
Yeah, so the best way to reach me is 123flip is my website, and anybody's always welcome to contact me by email, and it's just J, the letter J, at the numbers 123flip.com. J at 123flip.com. If there's ever anything I can help anybody with, just shoot me an email.
Wow, that's very generous of you. Thank you. Well, the one thing that you probably don't remember on our list of things to do is that we close out our show with our guests giving us their best old hound dog howl.
Ooh.
Yeah.
My dog is sitting right beneath me, but I don't think she's going to let out a howl, so I guess I'm going to have to do this, huh?
You got to do it on your own here, Jay.
Okay. Oh!
Oh, that was great. That had to wake your dog up.
Well, she's old and deaf, so she didn't even react.
Well, Jay, it has been such a thrill to have you on. I can't thank you enough. This is some good, solid stuff. And I know we ran a little bit longer than our usual shows, but I think that there's a lot of great substance there. So I want to thank you, and let's stay in touch. I definitely I'm going to be following your latest as you move into the multifamily sphere here, and would love to maybe somewhere down the road here talk to you again and see how everything is going.
This was a lot of fun. Thank you so much, Bill. And yeah, anytime you want to talk, that would be great.
Well, thanks for joining us. And also I want to thank all our old dog listeners out there just for taking the time. We know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. And please note, everything that we've mentioned here is in our show notes, okay, on our website at olddogsreinetwork.com/blog. And in there, look for the episode with Jay Scott. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward, and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.